Right, it's 4 o'clock. Welcome to you who've dialed in. Thank you very much for joining this afternoon session. It's a Friday afternoon. We come and relax, no suits, no ties. I was going through my computer and I saw that there was this presentation that I prepared, and it's been sitting there for a better part of almost a year now, and I've never shared it or given it out. So I just thought, let's put it out into the society, into our industry, so that we can share where we are. So if you don't know, my name is Kura Chiota. I'm the general manager of CBRE Accelerate, which is a Zimbabwean business. Our investor is a South African company in joint venture with CB Richard Ellis, the Fortune 500 listed company in New York. We are currently number 128, the Fortune 500. So here we've got great IP in Zimbabwe, and internationally, we're here to do business. So real estate is doing things in Zimbabwe that perhaps everywhere else in the world is not entirely doing. As number one, is an intense store of value. If you look at how the Zimbabwe Stock Exchange has performed, it's lagging any metric on inflation. You're not getting a real return. Inflation currently runs at over 1,000%. If you look at the indices, the real estate index from January until now is up close on 400%, but that's still lagging the inflation. So who's looking for what in real estate in Zim? Pension funds are looking for capital protection, i.e. when they receive their RTGSs at the end of the month, they're looking to deploy those into some sort of asset. Lenders who are getting thinner on the ground, holding RTGS assets, are looking to deploy and swap out from a cash into something, into a physical asset that they can hold on to, provide some sort of value protection and sell at a later stage. And retail investors, anybody who is working, is trying to put together a saving or two. So our retail options, we don't have unit trusts, money markets are not making any kind of sense. So we're putting out investors, and investors are coming through and looking for real estate assets. Tenants, they have expanding and changing needs. My business here has got several retail opportunities of guys who are taking a national view, and they're going forward and looking for sites in smaller towns, in larger towns, to expand a modern retail footprint that enables them to acquire some value from operating their business. Bills are still ringing, COVID notwithstanding, people are still doing business out there. In the listed sector, they exist. I just saw the ZPI, Zimbabwe Property Investment, they put out their results. They are 1.3 billion Zim dollar market cap, and their growth is going to be precipitated on acquiring other assets. So we're in a crazy time. We're in a crazy time where the rate is changing on a daily basis. Its velocity seems only ever faster. We're currently sitting on $80 to the Zimbabwe bond, or the Zimbabwe electronic currency. We're about 55 to the physical currency. So in this time of turbulence, real estate is an opportunity to create and store value. So what we find is the typical obstacles to finance real estate assets here in Zimbabwe. Number one is the investable product. So the investable product is discounting the future. What asset is going to be of relevance, of utility into the future? So they're existing assets, but you can argue that there's a large degree of underinvestment that puts the investment into a position of some economic obsolescence. So what is that? An office block in the middle of the city is physically still an office block, but when you don't have ZESA, you've got water. If you don't have ZESA, the water to pump up to the upper floors, lifts to get you to the upper floors. Yes, the physical asset exists, but you've got some economic obsolescence there. Liquidity is a challenge where in the market there are not a great number of mortgages that have been extended or we have the capacity to extend. Last number I saw out of the Center for Affordable Housing Finance is that Zimbabwe has a total of 16,000 active mortgages, which is not a great number at all. We need bankable viabilities. That viability is under pressure where we have a window. We don't know how long the window is for, where we have been allowed by the RBZ to trade and price in real dollars with the terms and conditions that it's free funds. The bank viability, we have to produce an asset that is financeable, that meets the terms and conditions of the financer. So the good old stuff of a title deed with an enforceable lease, with a real cash flow, with contracts, if you're taking a development risk, can that contractor deliver? Do you have guarantees? All of that needs to be in place for the finance to flow. Now, the acceptability of the due diligence, we do have a great deeds office able to register your real rights and protect them there, but we find a reluctance when we're doing development on locking that up. If you're trading in the South African environment, you'll buy land on a suspensive condition that the rights can be in place, that the geotech and the topographical surveys work out for you. Then you do a back-to-back with the tenant. You'll sign a pre-lease agreement, a development agreement. You can have all of those rights stitched up. Here in Zim, there's a lot more reluctance to be that methodical, and that gives us a challenge in producing an asset we can take through to an investment committee of any bank and get the finance. So when we're talking about raising funding, when we're talking about raising finance, the two ends of the continuum are debt, money out of my pocket that I'm taking out, I'm putting directly into the property, I'm funding it 100% myself. Opposite way around, debt is all borrowed versus equity, which is directly out of my pocket. So those are the 2 points of the line, and then we meet somewhere in the middle, and we have examples to show you of how that is worked here. So I'm going to take you through a couple of the market transactions that have been published. The first one, that's Corner House, located on the corner of Leopold Takawira and Samora Machel at downtown. The deal was struck with Old Mutual Properties, or Old Mutual as it was then. The sale price was $11 million back in the day when it was mandated at 1-to-1. The university put up a 1.9 million deposit. They were given 20 years to fund the balance or to repay that, and the interest rate was going to be 6.5% or CPI. When that transaction was formulated, we were in a 5-6% inflation environment, and subsequently that has become quite a thorn in the side, because the cash flows of, if you put CPI, and CPI was officially quoted at 676% when they started reissuing numbers by Zimstat. So the mortgage repayment, or the repayment of that vendor financed loan, was going to be problematic. In stable environments, vendor finance is viable, where the tenant is almost renting to buy over time. So the architecture of the transaction was feasible at some point in time, but I believe, and I haven't followed up on the unwind of that deal, but I imagine that it is untenable at this current stage. The second one is a build, operate, and transfer, where landowner, in this particular case, was the city of Bulawayo. They had land in a desirable location. A South African investor or a South African investor with some Zimbabwean partners put in a tender. They won the ground, and the plan was going to be that the land goes in as equity. The investor comes across the border with a bucket load of cash and invests into the property. The council would therefore receive, at the end of that lease period, they would receive a complete asset that was cash flowing and would be of benefit to them. So the build, operate, and transfer model operates with entities that can take a long-term view and are patient in waiting for the uplift, and you can get an energetic developer to do the top structure while you are there. The third example is Join a City. Join a City sits, it's the last new build that was done in the Harare CBD that sits on the corner of Julius Nyerere and Jason Moyo. The ground, there's 3 levels of basement, 3 levels of retail, and then 16 floors of offices up on top of that. That was done by a commingled real estate fund where a number of pension funds came together to pool resources, and they put money into the building on the basis of some equity and some debt. Though the debt was internal, it was shareholder loans, and for tax efficiency purposes, shareholder loans, the repayment thereof would keep the cash flow as neutral. So when you're doing a syndication, or when you're doing a project that is a bit larger than balance sheets that are available, or from a de-risking perspective, a commingled real estate fund where sizable parties can put together money to create a pool of money to be able to follow these transactions. Traditional debt and equity. I think this was the smartest property play in the past 2 years that I had seen. Tawanga Mall in Victoria Falls was concluded by ZPI, the listed entity. What they did is they sold Zimri Center, which is downtown Harare CBD, just off Leopold Takawira, and they developed a Pick and Pay anchored mall out in Victoria Falls, along the main drag, just opposite the Chokum Park, if you know where that is in Victoria Falls. What they did is they put in the proceeds of their previous sale, so the majority of the funding was equity that they raised elsewhere, a swap from office assets which were underperforming into retail assets that have a different income trajectory and a profile. If it's turnover based, you do quite well in inflation, but they did take on some debt to complete that. So they took on $2 million debt that had a fixed interest rate at 3.5 for 3 years, and that is a traditional debt plus equity kind of structure. What a lot of pension funds find themselves stuck with is illiquidity, where their members are contributing less and less over time, because if you're employed, you may have been retrenched due to the economic circumstances, so there's a greater draw and call on the assets of the fund. That the fund does not necessarily have the cash on hand to redeem. So what the construction industry pension fund did was, with their reserves and as one of their investments, what they did was they funded the infrastructure, bulk infrastructure. In Zimbabwe, that is always quite a heavy one, because our councils don't necessarily have the capacity, as well as it's now become a standard operating model for the ZESAs of this world to require you to pull power from wherever they have it nearby. You put in the substation, and you have the cherry on top where you hand over infrastructure to ZESA. So CIPF funded the bulk infrastructure as an investment, as a land development. They added value to unimproved land. This particular scheme is out to the south of Harare. If you're exiting Harare by the Mudzi traffic circle, you turn left going to Chitungwisa, it will be on your right-hand side. That's the location of that. So the pension fund funded the initial land improvement costs, and then the pension fund members got the benefit of being able to acquire those stands at concessionary rates. They couldn't give it away because that was pensioners' money, but you had used the bulk savings of the group to access an opportunity to pass on a benefit to your members. And on top of that, traditional mortgage finance was put in place. NBS provided mortgage finances on a title deeded registered property for those members. And the last example that I can point to in this environment, I do not believe that this project has broken ground yet. I know that that number would have significantly changed, but when we were going to press with this particular presentation, it was July last year, and this was much talked about. So ZPI, along with the CBZ, had expressed an appetite to engage in student accommodation, and how they wanted to fund it is that the ZSC has capacity for equity instruments as well as debt instruments. They were going to issue a debt instrument or list a debt instrument and receive those proceeds and deploy them into the accommodation and develop a student accommodation for that. ZPI has a track record. They have already produced, they did a conversion in downtown Bulawayo where they created a student accommodation. So Zimbabwe, where we are, we have the appetite. Lending is constrained, where we are holding these RTGS dollars, where our imports of materials tend to be sourced in US dollars. Trying to get a rate, trying to translate that money, trying to get it out is a challenge. So that makes us look more inward. So the opportunities that we have before us are typically syndications where people are coming in with various forms of equity. There's a transaction that I've been advising on where a landowner service stands. He's put that up and he will retain his value that comes in at a number. A bank will be taking a funding position. They will build or they will fund the building of top structure. That top structure, upon completion and the development of the whole development, the bank will not get a cash redemption. They will get a number of the developed units. So there's an equity split where landowners put in equity for value. He's recognized for that. A funder comes in and brings in cash, and the redemption of their cash is by receiving completed units. It's not for everybody. That was low-cost housing, so the import component of that was rather low. So with Zim dollars, there was a quite tidy fix that you could do on producing houses in a pretty quick turnaround. What most people are uncomfortable with is, where does my money go? How long does it hang around for? And what do I get out at the end of it? So we have to treat those risks quite seriously in Zimbabwe, where credible track record, due diligence where you've got real title, i.e. sight to the ground, with a title deed that you can pledge or hand in as security. But the appetite is there in all sectors: residential, retail, industrial, their demand. We are constantly battling to find quality tenants who are there, some of them listed, some of them unlisted, who are looking to continue trading. We've seen the retailers, the Metro Peach and Brown, electro sales, they're all expanding their footprint and they're looking for better quality assets. Big boxes, which are closer to the lower LSMs, because there's money that's available for spend. So with that, that is the presentation I provide, and I'm happy to take questions for you.
Thanks for a great presentation. My question is, as I've understood it, and I just want to confirm that, in the current environment, taking a view on a property asset in Zim is predicated on, one, looking in the long run at a turnaround, which will then give you capital appreciation at some future point. I'm trying to understand, is there an opportunity for somebody who is based outside of Zimbabwe to then see capital appreciation in today's Zimbabwe in respect of investing in property in Zimbabwe today?
Okay, thanks.
From
Thanks.
outside.
Thanks, thanks for asking that question. Look, we're strange people in a strange place doing strange things. We contort any asset to preserve value. So our investment decisions are not necessarily purely property driven. I'm not sure if you caught me right at the beginning of the presentation where I said we as Zimbos we're trying to make too many things do too much. So I think it'll be difficult to make a case with a reasonable certainty on a model that you're going to do an NPV. This is my in cost. This is the rental. This is the reversion. And at the end, I'm going to sell it for X. I think we've got too many variables that are going to go into that pie to give us an answer. I think for people who have money in country, as opposed to somebody who's going to mark against the real dollar he put in versus the real dollar he gets out, I think we're going to have a questionable case on that. But for those who are here in Zimbabwe, what are you going to do with a pile of Zim dollars that is depreciating by 20% every 14 days? So our play here is, I would say we're torturing real estate to provide us some capital protection, and the capital gain that we will make might be a paper gain because we're earning more Zim dollars for it. But I would say academically, our rentals are lower than the rest of the region. So if you take a long-term view, when we normalize, will we get a reversion of market rentals to be something closer to what the region is used to paying? I think there could be some upside. But I know you're a numerate guy, so putting that into a spreadsheet, the numbers are not going to make sense to you, my brother.
Thanks. Very clear. Thanks very much.
Okay. I also have a question. I don't know if you can hear me. Can you hear me?
Loud and clear.
Okay, so I've heard of, so it's twofold. So I've heard of something called a sovereign guarantee, where the government offers a guarantee for offshore investors who come in with money for a business. So
Yes,
if I came in and I brought in some investment as an offshore investor, how accessible is it for a property investment, that sovereign guarantee that it is after a certain amount of time, I'll be able to cash out my Forex that I've invested?
I think you're going to take significant sovereign risk on that. So the person who's issuing the guarantee, what capacity do they have to honor that? What capacity do they have to honor the currency obligations? You recall when we dollarized, there was a sanitization where they said, look, there's some legacy debts which will guarantee it 1-to-1. I don't know of any one of those transactions that have been settled. So on paper, I have physically seen state guarantees, but I'm yet to see somebody perfect that security and get satisfaction. So I hold no brief for the state and the state entities, but I think you need to do a DD on what is the mechanism for you to be able to call on that guarantee, what are the T's and C's that go along with that, and perhaps see if anybody else has been able to successfully do that. I don't think I can point to an example where that has happened.
Okay, I guess that's sensible. Then that sort of gets us to the second question, where you were talking about the whole thing. So my understanding of your presentation seems to be more for large commercial developments rather than the normal sort of individual household investor. So then, in light of me not having any big assets, so if I have a 45,000 rand, dollar house in Southerton, and I want to buy a house in Borrowdale that costs maybe twice as much, how much can I leverage my less value property that I have to finance me getting the bigger, nicer house?
Yeah, anecdotally, if you're in country and trying to do it in country, I think you're going to face a first hurdle on showing some sign of cash flow that allows you to access even 50% of the value that's currently in your house. So your 45,000 Southerton house is worth 20 million Zimbabwe dollars at current parallel rates. For you to be able to draw $10 million, you're going to need to show 100,000 in cash flow just to qualify for the mortgage. So a typical mortgage, shorten the terms as little as a year ago. There was 20-year terms, but mid-transaction, I was trying to do a refinance transaction. They brought that down to 3 years. And 3 years, it pushes up the affordability element because you've compressed the time. So your ability to access that 45, I find it will be difficult. For you to acquire existing real estate, I think you are losing value because what exists as a premium over the cost of land plus bricks plus labor to get you there. So going into that higher property that exists, I think if you buy an as-built, you're risking some value there. But on the residential, on the one-on-one, I would imagine if you try to club together with some schoolmates or your friends and family, form some sort of syndicate. So how Joiner Center was organized, well, that was at scale because the guys had the bucks and it was that kind of a sophisticated project. But you're clubbing together various amounts of equity that you have to be able to do that. I don't think there's a debt instrument that can help you to access Zimbabwe dollars to buy a US dollar price asset. There are banks, and I'm still testing it right now, that are saying if you've got a US dollar income, be you an employee of a mining house, and you can show that you're getting your money into your nostril, they're able to advance you 50% on that in dollars. But other than that, I can't see the opportunity. I stand to be corrected.
All right, that's fine, I guess. Thank you.
Anybody else?
All right, I'll go. Hi, Kura. What opportunities are there right now, or will there ever be? Will we see an increase in opportunities of student accommodation? Because from my basic understanding, with the economy as it is in Zimbabwe right now, you're going to find a lot more students being admitted to the local universities, and you might find that these might premium sort of residents, unlike the ones that are currently offered. So is there any play that could be, between the large commercial zones, the large commercial projects that were spoken of before, and the residential ones, and then we have that median zone where we've got student accommodation? Are there any opportunities?
Okay, great question. I think the flavor...
We're likely to see an increase in such.
Yeah. The flavor of the month for the past 2 years was doing student accommodation. CBZ had put aside $400 million back in the day. IBDZ also had put together a fund. A number of the listed players, ZPI, had done something. They were looking to do something. NASA had a scheme that they looked at for the National University of Science and Technology. Great space. When I looked at a project, my question mark was around the creditworthiness of it. Who is the tenant? Because when things go crunch, you need somebody's balance sheet to go after. Universities themselves were reluctant to take on the liability that if you build this facility and somehow things go wrong, exposure that they would have on those lease commitments could take them away. So there was risk on who signs the lease. If it's mom and pop and they're sending Joan or Jane to school, they probably sold the last goat that they have. If they sign a lease and things go wrong, who do you go after? I wasn't sure of that. Then the ability to pay. Who has the cash flow to be able to pay? Now, all of that being said, a lot of the real estate, a lot of the student accommodation developments were done on BOTs where the university would say we'll put up the land. So I think that locks out some kind of funding because you don't have the traditional access to security being the land. You've got the creation of an asset, which is the cash flow, which is in question, and people worry about that. But that being said, if you took a Google Earth, perhaps it wouldn't give you all the great detail. But that Mount Pleasant strip in front of the UZ, there have been some excellent residential conversions that have been done to accommodate 20, 30 students at a time. And those premium spaces are getting $80 US a head. So that adds up. I know one guy who's getting about $3,500 real dollars a month on that kind of a basis. So at a smaller scale, it's working. At a larger scale, I always worry about the almost utility nature of student accommodation, where you can get an SI, you've got 300, 400 students, they can organize form the Zimbabwe Student Union, they get the ear of the politician, and all of a sudden you're interdicted from raising your rentals, or they have a strike against you. So student accommodation has been attractive. The only example I've seen of it on the ground from an institutional basis has been ZPI in Bulawayo. But I do know if you go to NUST, the houses that are around there have even 60 students in some pretty appalling accommodation. So it's well worth looking at to create a model, a low-cost model. I don't think 100 units is necessary. You can do the smaller units, and I think you'd find takers. In the small little university towns, Lupane, Pindura, I would imagine that they're wide open. If you can get a bursary student who is backed up by a corporate to guarantee that rent, I think you'd be on a winning wicket.
All right, thank you so much. Very informative.
Right. Any further questions? I see there's some late members, Anna Eswad Bunyangadzi, coming in at 4:30 for 4:30 close of a meeting. All right, you're welcome, my brother. Karim.
Hi, Kura. Can I just jump in and ask a question?
By all means.
I'm curious to find out about the possibility of gentrification in our town buildings, similar to kind of what was trying to happen in Joburg with some of the buildings there. Is there, firstly, the buildings that that sort of model can work with locally, or are they all just owned by your big old mutuals who are happy to just sit on them until such a time as town is revived? Or are there such opportunities available in our own town center?
Thanks. Great question. On the Sundays that I drive into town, QV pharmacies, 24 hours. So when you need to get something in the middle of the night, I tend to find they got the best stock. So if you know the QV building in town, Robinson House, there are a couple of others, yes. Temple Bar House. There's some buildings that if you've got a Joburg or Cape Town background, you will see that that floor plate is ideal. Long corridor, natural light windows on either side with less than 3 meters if you put services down the center. So I think physically the assets exist. I think what we're lacking is two things. One, I do believe council is open to, but I'm yet to see it as a fait accompli on mixed use where you have accommodation above retail. I do believe Old Mutual in their property, Speak Avenue, Corner Speak, and 2nd Street, they were looking to convert that to residential. I think that was going to be a great pioneer for all of us to use that, whatever exemptions they had used for the application that they had gone through. I I find that the city, so intellectually, we should see that reuse, repurpose of buildings to go to the conversion of those to be accommodation. But if you look at property economics on the ground, you're finding that any flat within a CBD or within the avenues, particularly around economic areas. So if you're around Avenues Clinic, the flats that are there, the bed sitters have been converted to pharmacies or consulting rooms or diaper sales places. So the demand or the economic opportunity is less for housing than it is for office accommodation. So I think that's mitigating something against the demand to convert and spend money to convert to create smaller spaces, because the demand is more for offices of smaller spaces than it is for residential. But I think at some point in time, we will get back to the need for the accommodation where somebody has started a job, wants to move out of home, and wants to rent 45 square meters. We have not seen much construction of that past the pension funds. If I remember right, it was the ZESA pension fund that did the Farai courts, the Charingira courts. We haven't seen any scale development happening like that. So in the long run, or in the medium run, I see that there will be some pent-up demand for affordable, closer location, affordable spaces. But the economics on the ground right now, I don't think are providing for it.
Thanks, Korea. That's helpful.
Right. Anybody, anything else? It's a Friday afternoon. I don't know if you've got cold drinks in hand or beer or nyama on the go. But yeah, I just picked this Friday to share this material that is out there. But I just thought, look, I've done the work, and we just all got to keep our minds active and share what we've come across to edify each and one of us who's invested in this industry.
Now, thank you very much for that. Are you open to sharing this with the people who are on the call, sharing the deck?
I am indeed.
Wonderful. Thank you very much for that. Thank you very much, and for yeah, making yourself available to share your perspective and insights with us.
Only a pleasure. I am here. I wave the flag. I've got to make it work here. Look, these are the turbulent times. I'm here to try and grab a few more assets for myself here. The concept of going back to Joburg and living there, dodging bullets and all the rest of it. I like leaving here and going to watch the sunset on my 2 acres in Glenlawn. So I'm here, and I've got to make this work.
Thanks very much. I'm going to sign out and look forward to receiving the deck when you send it.
Perfect. Take care, everybody. Thank you very much for your valuable Friday afternoon and your questions. Be well, and
Thanks, Kura.
All right.
Thanks, Greg.
Thank
Thanks
you,
a lot.
Thank you.
Thank you.
Is it over already? Am I late?
This